The U.S. auto market just got hit with a shockwave, and it's coming straight from Stellantis. In a move no one saw coming, the global automotive giant has unleashed massive price cuts across its most popular brands: Jeep, Ram, Dodge, and Chrysler, sending the entire industry into a frenzy. We're not talking about small rebates or seasonal incentives here. We're talking about thousands of dollars slashed off sticker prices, dealer lots suddenly flooded with buyers, and rival automakers scrambling to figure out how to respond. For months, Stellantis dealers have been sitting on mountains of unsold inventory. Rows of Ram 1500s, Jeep Grand Cherokees, and Dodge Durangos were gathering dust as high interest rates and inflated prices kept customers away. But now, Stellantis is detonating a pricing bomb to clear the backlog, offering discounts so aggressive that some trucks are selling for 2019 prices. Buyers who were priced out just weeks ago are now rushing back, and social media is blowing up with people bragging about the deals they scored. Industry insiders are calling it the price war trigger, because if Stellantis can afford to cut prices this deep and still move units, Ford, GM, and even Toyota might be forced to follow. That could mean the first real affordability shift in the auto market in years. But here's the catch. These discounts aren't just about being generous. Stellantis is playing a high-stakes game. By moving old inventory fast, they're making room for their upcoming wave of next-gen models, many of which are electrified. And if they can flood the roads with cheaper Stellantis vehicles right now, they could lock in long-term brand loyalty before their competition even gets a chance to react. But this strategy isn't without risks. Dealers might see their margins collapse. Customers who bought at full price just months ago are furious, watching the same vehicles now go for thousands less. Used car values for Stellantis models could nosedive overnight, leaving owners upside down on their loans. And behind the scenes, analysts are warning that Stellantis could be lighting the fuse on an all-out auto industry discount war, one that could shake every dealership in America. The most shocking part? Reports are already surfacing of Jeep Wranglers with $8,000 markdowns, Ram trucks going for under $40,000, and Dodge Chargers being practically given away compared to last year's prices. Some dealers say they've never seen a manufacturer push this hard, this fast. Inventory that was expected to take months to clear is now moving in days, and it's sending shockwaves through auction markets and financing companies. And here's where things get even more interesting. Whispers from inside Stellantis suggest this isn't just a short-term clearance sale. Insiders claim the company might keep these lower prices locked in for the rest of the year, especially if it forces rivals into a corner. That could completely rewrite the pricing playbook in the U.S. auto industry, where inflated MSRP tags have been the norm for years. If Stellantis holds the line, other automakers will have no choice but to match or risk losing massive market share. Wall Street is already reacting, and not everyone is celebrating. Stellantis stock took a small dip immediately after the discount news broke, as investors worried the aggressive pricing could eat into profits. But some analysts are calling it a long-term masterstroke, predicting that the surge in sales volume could more than make up for slim margins. Auto industry veterans know this game well. When one big player goes for market share over profit per unit, it often forces the entire industry into a brutal survival contest. And right now, Stellantis seems willing to take that risk to cement its position in the U.S. market. Meanwhile, the ripple effects are already hitting the used car sector. Dealers who rely on high resale values for trade-ins are suddenly finding themselves in trouble. That Ram 1500 bought for $55,000 last year, it's now competing with brand new ones sitting on lots for under $45,000. That instantly slashes its trade-in value, leaving owners shocked and in some cases angry. Auction prices for Stellantis models have started to drop, and if the discounts keep coming, we could see a sharp, industry-wide collapse in used vehicle pricing. Over at Ford and GM headquarters, the pressure is mounting. Internal sources claim both companies have been holding emergency strategy meetings to figure out how to respond without sparking a profit crisis of their own. Ford dealers, already struggling to move F-150s at sky-high prices, are terrified that Stellantis' move will siphon away their truck customers. GM, which has been relying on strong Silverado and Tahoe margins, is in the same boat. Neither can afford to lose ground, but neither wants to start a full-on discount war that could gut their bottom line. And then there's the customer psychology factor. For years, buyers have been conditioned to believe that big discounts are rare in the new car market, a post-pandemic side effect of low supply and high demand. But Stellantis just broke that illusion. Once consumers see that it's possible to get thousands off, they're going to expect it from everyone. That could permanently reset buyer expectations, forcing an industry-wide shift toward lower prices and bigger incentives. What's even more intriguing is how this could impact Stellantis' upcoming EV push. With brands like Jeep, Ram, and Dodge preparing to launch electric and hybrid models, these discounts could serve as a loyalty trap. Get customers into a Stellantis gas model now at a killer deal, then upsell them to an EV in a few years when they're ready to trade in. If that's the plan, it's a bold one, and it could leave rivals scrambling to catch up in both the gas and electric markets. But there's another layer here, a global one. Stellantis isn't just playing the US market. It's a worldwide giant with footprints in Europe, Asia, and beyond. If this price-slashing strategy works in America, it could roll out to other key markets, igniting an international price war in both combustion and electric segments. That's the kind of move that could completely redraw the global automotive power map. On the ground, dealers are experiencing a scene they haven't seen in years. Foot traffic is spiking, phones are ringing off the hook, and online leads are pouring in. Some Stellantis showrooms report weekend sales numbers that rival pre-pandemic boom years. Sales managers are working late into the night just to process the influx of buyers rushing to lock in deals before the inventory dries up. The atmosphere is electric, but beneath the excitement, there's also a hint of chaos. Salespeople are fielding calls from frustrated recent buyers who feel blindsided. Imagine paying $63,000 for a loaded Ram 1500 in March, only to see the exact same truck now being offered for nearly $10,000 less. Some customers are demanding trade-ins, others are threatening lawsuits, and a few have even taken to social media to publicly shame their dealerships. While the discounts are driving massive short-term sales, they're also creating long-term tension between Stellantis, its dealer network, and loyal customers who feel betrayed. Financing departments are also in a frenzy. Lenders are quietly worried about the wave of negative equity these discounts are creating. When the value of a new car drops the moment it leaves the lot, and now even before it's sold, it increases the risk of loan defaults. Banks and credit unions are tightening approval standards for Stellantis vehicles, which could ironically limit the number of buyers who can even qualify for these big deals. Meanwhile, rival dealerships are scrambling to respond creatively without slashing prices too deeply. Ford dealers are rolling out free upgrade packages and 0% APR offers. GM dealers are pushing aggressive trade-in bonuses to keep customers from jumping ship to Jeep or Ram. Toyota dealers, known for avoiding deep discounts, are suddenly offering unheard of cashback incentives on select models in key markets. It's clear Stellantis has forced everyone's hand. And it's not just about moving metal. This discount blitz is also affecting the perception of brand value. Jeep has long marketed itself as a premium adventure brand, but now, heavily discounted Wranglers and Grand Cherokees are starting to look less exclusive. Ram, which has worked for years to position its trucks as luxury workhorses, risks cheapening its image if buyers associate them with fire sale pricing. The danger for Stellantis is that while discounts can fill lots today, they might devalue the brand tomorrow. Industry analysts are split. Some say this is exactly what the auto industry needs: a reset on ridiculous pandemic-era pricing that priced millions of Americans out of the market. Others warn that Stellantis could be starting a race to the bottom, where the only way to compete is to sell vehicles for razor-thin margins, eroding profitability across the board. And in an industry already facing expensive EV transitions, supply chain volatility, and looming union labor disputes, slashing profits might be the last thing anyone can afford. The timing of this move couldn't be more explosive because the 2025 model year launches are just around the corner. Automakers typically use this period to clear out old stock with modest incentives. But Stellantis has taken that playbook, cranked it to maximum, and thrown it into overdrive. The result? Customers who might have been saving up or waiting for the new models are now rushing to grab outgoing inventory at record low prices, leaving rival brands staring at unsold 2024s with no way to compete without slashing their own margins. This surge in clearance sales is already bleeding into the used car market. and the effects are brutal. Wholesale auctions are reporting drops of several $1,000s on late-model Jeeps and Rams in just a matter of weeks. Used car dealers, many of whom bought high-priced inventory months ago, are suddenly sitting on depreciating assets they can't move without taking huge losses. Some are freezing purchases altogether until the market stabilizes, a sign that the ripple effect from Stellantis discounts is only beginning. Then there's the looming threat to the auto loan industry. As prices tumble, banks and lenders are facing a dangerous spike in negative equity cases, where borrowers owe more than their car is worth. It's a financial time bomb. If economic conditions worsen or unemployment ticks up, defaults could soar, hitting not just auto lenders but also credit unions and even regional banks. The stability of entire loan portfolios is being questioned, and some financial analysts warn that if this discount trend spreads, it could trigger a mini financial crisis within the auto finance sector. Meanwhile, inside Stellantis, the move is being portrayed as a bold, strategic shift, a reset moment designed to force the market back to realistic pricing and position the company as a volume leader going into the EV era. But leaked memos hint at another motivator: pressure from European headquarters to hit aggressive U.S. sales targets before the rollout of multiple new EV models, some of which have faced delays. By clearing the decks now, Stellantis ensures its dealers can take on the new wave of vehicles without being buried in unsold inventory. And this strategy has a psychological edge. By creating a feeding frenzy now, Stellantis is conditioning buyers to believe that the brand offers the most aggressive deals in the market. That perception can carry forward for years, making customers far more likely to check a Jeep, Ram, or Dodge before even looking at a Ford or Chevy. If they can win that mental real estate, they win the market share war. But the question that nobody can answer yet is, how long can Stellantis keep this up before the financial strain becomes too heavy? The auto industry is littered with examples of brands that played the deep discount game too long and ended up eroding their profitability and brand prestige. If this gambit backfires, Stellantis could find itself locked in a race to the bottom that nobody can win. Behind the scenes, dealer backlash is brewing. While the discounts are bringing in traffic, some franchise owners are quietly furious at Stellantis for undercutting their margins so aggressively. Many dealers rely on a balance between manufacturer incentives and their own markup to stay profitable. But with these factory-backed cuts, that balance is gone. Some are complaining that they're now moving more vehicles than ever, but actually making less per sale. A dangerous dynamic in an industry where high fixed costs mean volume alone can't keep the lights on. Adding fuel to the fire, certain dealers are reporting increased tension with customers who want to negotiate even deeper deals on top of the already slashed prices. Buyers have caught wind that Stellantis is desperate to move inventory, and that desperation is shifting negotiating power away from the dealer. In some cases, customers are walking out if they don't get extra add-ons, free maintenance packages, or further markdowns. What was supposed to be a surge in easy sales is turning into a high-pressure environment where dealer staff are burning out fast. And there's another hidden cost Stellantis might be absorbing: logistical chaos. When vehicles start flying off lots this quickly, supply chain pressures shift in unexpected ways. Shipping schedules get disrupted, allocation systems get overloaded, and some dealers are already warning that if Stellantis doesn't manage replenishment carefully, certain models could sell out completely in specific regions. That's a double-edged sword. Scarcity might drive demand, but could also send frustrated buyers straight to competitors if the model they want isn't available. Then there's the inventory replacement problem. Vehicles sold at heavy discounts now will need to be replaced with new models. But if production costs for the upcoming 2025 and 2026 lines remain high, Stellantis may not be able to maintain the same aggressive pricing without taking bigger losses. That means this discount strategy might only be sustainable for a short burst. And if they can't keep it going, they risk creating a sudden pricing whiplash that could alienate customers. The real danger, however, is the industry-wide collapse scenario. If Ford, GM, and Toyota decide they have no choice but to match Stellantis discounts, the U.S. auto market could see its biggest price reset in decades. That would delight consumers in the short term, but could devastate manufacturers' profit margins, force layoffs, and stall investments in future tech, especially costly EV development. It's a high-stakes game of chicken, and right now Stellantis is flooring the gas pedal. Union labor negotiations are the next potential flashpoint that could collide head-on with Stellantis' discount strategy. The United Auto Workers have already been pushing for higher wages, better benefits, and stronger job protections, and these deep price cuts could give them fresh ammunition. If Stellantis is selling vehicles for thousands less, union leaders may question whether the company is undercutting profitability just to win market share, and whether those short-term sales surges might come at the expense of long-term job security. Any hint that discounts could lead to plant slowdowns or layoffs would ignite tensions instantly. Meanwhile, the EV battlefield is heating up. Tesla has already proven that aggressive price cuts can shake an entire industry. But Stellantis is bringing that strategy to the traditional gas-powered segment, where profit margins have historically been higher. The twist? Stellantis is doing this just months before rolling out its own EV lineup, meaning the company could use its sudden boost in market share as a launchpad for its electric push. If buyers already see Stellantis as the value leader, it could be easier to convince them to choose a Stellantis EV over a Ford Lightning, Chevy Blazer EV, or even a Tesla Model Y when it comes time to switch. But internationally, the move could create turbulence. Stellantis is a global player with strongholds in Europe, South America, and a growing presence in Asia. If U.S. discounts prove wildly successful, shareholders and analysts will pressure the company to replicate them overseas. That could ignite pricing wars in markets that are already fragile due to inflation, high interest rates, and slower EV adoption. In places like Europe, where environmental regulations and production costs are higher, Stellantis might not be able to sustain the same deep cuts without bleeding cash. There's also the danger of brand dilution on a global scale. Jeep, Ram, and Dodge carry certain reputations abroad. Jeep as a rugged off-roader, Ram as a premium American truck, and Dodge as a muscle car powerhouse. Heavy discounting in the U.S. could send ripples into those markets, making foreign buyers view these vehicles as budget options instead of aspirational purchases. Once a brand loses its premium edge, it's nearly impossible to get it back without a costly rebranding campaign. In the background, competitors are sharpening their strategies. Ford and GM are rumored to be considering selective shock sales in high-volume markets like Texas, Florida, and California to counter Stellantis' surge without going fully national with price cuts. Toyota, on the other hand, seems content to wait and see if Stellantis burns itself out financially before reacting. A risky move that could either preserve their margins or cost them significant U.S. market share. And all of this is playing out in real time, with each week's sales numbers becoming a mini verdict on whether Stellantis' gamble is paying off or setting up for a crash. If there's one thing the auto industry has learned over the past decade, it's that once consumers get a taste of lower prices, there's no going back. Stellantis may have just flipped a switch in buyer psychology, and not just for its own brands. Shoppers who see $8,000 to $10,000 discounts on Rams and Jeeps are going to expect similar deals from Ford, GM, and even Toyota. That shift in expectations could force the entire industry into a permanent pricing reset, undoing years of slow, deliberate MSRP inflation. This reset wouldn't just hit automakers. Suppliers and parts manufacturers would feel it almost instantly. Lower vehicle prices mean tighter profit margins, and when automakers look for savings, they almost always push the squeeze down the supply chain. That could mean smaller contracts, delayed payments, or even canceled orders for parts makers, a ripple that could cost thousands of jobs in communities across the U.S. local economies tied to auto manufacturing would also be in the crossfire. Towns anchored by Stellantis plants might see a short-term boost from production surges, but if profits dry up and the company is forced to slow down, the same communities could face layoffs, reduced shifts, and economic slowdowns. Even dealerships, currently enjoying the rush of traffic, could feel the sting later when margins stay thin, but expenses keep climbing. In the short term, Stellantis' gamble has electrified the market, driven buyers back to showrooms, and forced its rivals to rethink their entire playbooks. But long-term, the question remains, is this a calculated masterstroke that will redefine the industry, or the opening shot in a race to the bottom that could bleed every automaker dry? The next few months will tell the story. If sales volume explodes and Stellantis can maintain momentum without gutting profitability, it could emerge as the clear winner in the post-pandemic auto market. But if the strategy backfires, it won't just hurt Stellantis. It could trigger an industry-wide collapse in pricing power, profitability, and brand value. For now, one thing is certain. Stellantis has changed the conversation. Every automaker in America is watching. Every dealership is on alert. And every car buyer just realized they might not have to pay as much as they thought. The bombshell has dropped, and the aftershocks are only beginning.